Assalamualaikum warahmatullahi ta'ala wabarakatuh, and hello to all of you. This is the lecture for chapter 12, Managing Consumption Credits in Retirement Planning. This topic is important because in retirement it is of no use if you have a huge retirement fund, but at the same time you are trapped into debt or huge amount of credits. Therefore, as a part of the retirement planning, it is also important for you to manage the credits of the client. In this chapter, we are going to look at the rule of 78, the consumption of higher purchase loan interest and installment, the concept of annual percentage rate and effective annual rate, or we call it as EAR. We're going to look at the credit cards and how much you actually pay for the interest in credit cards, AKPK and its role in debt management. So AKPK is one of the organization under Bank Negara who is in charge of handling debt or credits for those who have this problem. And we are going to look at the cost of purchases under weekly and monthly installment schemes for those who like to buy, for example, furniture or electrical appliances by using this method, paying by monthly or paying by weekly. So we are going to look at, how much you actually pay to them. That is basically among the things we are going to cover in this topic. As an introduction, when we talk about retirement fund, we think about the investment on how we accumulate the retirement fund. That is the one part of retirement planning. Another part is actually on how we can reduce the debt once we reach retirement age, because we are no longer capable on how to pay debt during passive income that we have when we reach our retirement age actually. So we have to focus on both. And if we have huge retirement fund but at the same time we have huge debt, then the plan for the retirement will not work as what we planned. Therefore, it is important for us to actually cater for both of the issues at the same time prior to the retirement. And this is also individual debt should be also a part of the retirement planning for us. When we talk about consumption credit, we are talking about the consumption for the personal use. For example, we make a loan or debt to purchase car. Other than that, we might spend on the credit card loans to buy the personal belongings and to pay the bills. Or sometimes we make a credit or installment scheme for us to buy the household goods or furniture or electrical appliances. So all of these three categories, we classify them as a part of the personal consumption, okay, or consumption credits. Nevertheless, for housing loan, okay, we didn't classify housing loan as a consumption credit, although it is actually for personal consumption. This is because housing loan, it is actually an asset that not deplete over time, because when you buy a house, the value of the house will be increasing. So that's why we didn't classify that as a part of personal use asset, although it is actually for the purpose of personal use. Other than that, for example, like household goods, you buy furniture or electrical appliances, the value of all of these items will be reduced over time. That is basically the principle on how we should classify something as a consumption credits or not consumption credits. The first consumption credit that we're going to look at is what we call as hire purchase, which means we are referring to the car loans. In Malaysia, for example, given that the public transport is not that efficient, we have no choice but we have to buy a car for us to move from one place to another. And the principle of 78, or we call it as rule of 78, will be used in hire purchase of the car. Sometimes the rule of 78 also will be called as sum of digit approach. This is a rule that is legalized and regulated under the Hire Purchase Act of 1967 in Malaysia. In recognizing the monthly interest income from hire purchase loans, financial institutions use the rule of 78 to apportion the total interest income. If the total interest income for the loan is 6,000, the monthly interest income over the 12 months period shall be computed in Schedule 1 as follows. In this instance, it means that if the total interest income for a loan is 6,000, they will use the rule of 78 to allocate the amount of the interest for each month. As in this case, the duration or the tenure is 12 months. Therefore, if you look at Schedule 1, for the first month, okay, and this is the numerator, and this is denominator, times with 6,000, alright? So, as in this numerator, it will start from 12. That is actually the number of installment, because the duration is 12 months, so the numerator for the first month is 12, and it will be reduced 11 up to, like 1. That is for the last months. Okay, that is the 12 months. The denominator is 78 for all entire calculation. And how we can get the monthly interest is where we have to divide 12 divided with 78 times with 6,000, that is the interest. Then we can get 923.08, and we can see that the figure will be reduced, which means the interest, they will charge you the highest on the first month, okay, and it will reduce once you reach the end of the term. You can see that the amount of the interest is the lowest, that is 76.92, but they will charge you very, very high at the beginning of the loan duration, okay, or at the beginning of the loan tenure. You should understand that if you pay, let's say after 10th month, you feel that you want to pay your loan in full, then you should understand at this stage, okay, you already paid lots of your interest and you are actually reducing your principal. Okay, this is how the bank works with the calculation for the interest. At the beginning of the term, you pay lots or very huge amount from your installment will be going to serve for your interest. Okay, so this is how it works. How we are going to calculate the total interest? We can calculate the total interest by using this formula, P times R times N, where P is actually loan amount, R is flat rate, and N is the loan tenure in number of years. So assume that we have a loan tenure of 12 months and loan amount of 120,000, and the interest rate of flat rate is 5% per annum. Therefore, 120,000 times 5/100 times with 1 year, okay, that is 12 months. We now get the total interest per year is 6,000. Alright, actually I should explain to you a little bit detail on how we get this denominator of 78. This denominator that is 78 is actually the sum of digit from 1 to 12, because the duration is 12 months, which means we add the sum of digit from 1 to 12. 1 plus 2 plus 3 plus 4 plus 5 plus up to plus 12. Up to the 12 months, then we can get 78. So it becomes the denominator. This denominator will change if the duration of the loan change. So let's say, by taking another example, let's say for a 2-year hire purchase loan of 120,000 with a flat rate of 5%, then the total interest will be 12,000. Okay, in the sense that if we are going to calculate this using the table, then if we want to apportion our interest, then we shall see that the denominator now changed to 300. Okay, so if you look at this table, the month is up to the 24th month. Okay, and if you look at the numerator, it starts with 24 because it is for 2 years, which means equivalent to 24 months. Alright, so this is how we are going to calculate our interest. Amount of loan times with the flat rate times with 2 years, then we can get the total interest is 12,000. And how we are going to apportion this 12,000, if we use this table, then you can see the numerator start with 24 and it will end with 1. Okay, the denominator is where we sum all of, like from 1 to 24. Okay, you add 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus up to plus 24, then you can get the 300. The 300 will become the denominator here. So 24 divide with 300 times with 12,000, then we can get the interest for the first month. For the second month, 23 divide with 300 times with 12,000, then we can get 922. And similarly, you can see that at the beginning of the loan term, the interest that you serve, or the interest or a portion of the interest, is very, very huge. And it's very, very much difference between the first month and the last month. Okay, the amount of interest you pay in the first month is 960, while the amount of interest you pay at the end of the term is just 40. Okay, this is actually the rules on how the bank will apportion the interest as well as the principal that you have to pay every month. Okay, here is the table of amortization for hire purchase loan of 120,000. We already calculate the interest using a flat rate of 5%. Therefore, the interest will be 12,000, and we already calculate before how we apportion the interest to the monthly payment that the client have to pay every month. Now we are going to look at this schedule of hire purchase loan, and this is the table of amortization, where the beginning balance is 132,000, where we have to add 120,000 plus the 12,000 of the interest. And it is very easy for us to calculate the installment because we just need to divide this 132,000 with 24 months. So which means for every month, client have to pay, or the customer have to pay 5,500. We already calculate the interest before using the rule of 78 or sum of digit approach. Therefore, we will divide this installment into principal and interest, and at the end of the term, we can calculate the ending balance. So for the first month, the ending balance will be 126,500, where 132,000 minus with 5500, then we can get 126,500. This 5500 installment paid by the customer will be divided into interest and principal components. Given that we already calculate using the rule of 78 or sum of digit approach that the first month of interest is 960, therefore the interest will be 960 for the first month, and the others will follow. Okay, so at the end of the term, we can see, alright, that after 24th month, the balance will be 0. Okay, now we look at the nominal annual rate as well as effective annual rate. In banking and finance, interest rate is normally stated on the annual basis. Okay, nevertheless, for credit card, normally it will be stated on a monthly basis. For example, normally the annual the interest rate for the credit card is 1.5% per month, right? Given that it is, like 1.5% per month, it is actually on monthly basis. Therefore, it is hard for us to make a comparison by using a monthly basis, since that in a normal practice, the interest rate normally stated using the annual basis. Therefore, to make it more sensible for our comparison, 1.5 we have to times with 12 months, then we can get that the credit card annual interest should be 18% per year. 1.5 times 12, or equivalent to 18% per year, which is actually very, very high. Okay, so this is something, like 18% per year. We call it as nominal annual rate. Okay, nominal annual rate. Nevertheless, beside of the nominal annual rate of 18%, in financial planning, we are more concerned with effective annual rate or effective annual interest, because the effective annual interest is more important since it's considered the monthly compounding effects within a year. Okay, so nominal annual rates of 18% like this is something that will be stated in a year mode, and this rate will appear in the financial instrument. Nevertheless, if you study further about the interest, you will know that it is actually the effective annual interest is playing a big role in the calculation here. How to calculate effective annual interest? You should calculate the effective annual interest by using this formula, where 1 plus monthly interest, because it's a monthly, so you have to use a power of 12 minus with 1. Okay, so you will get 1.1956 minus 1, or equivalent to 19.56%. So, as in this case of credit card, the nominal annual interest will be 80%. How you can get this 18%? 1.5 times 12. It is very straightforward, but how you can get effective annual interest is by using this formula, 1 plus I, a power of 12 minus with 1, then you can get 19.56%. At this point of time, it is very clear that the effective annual interest is higher than the nominal annual interest.